Hello Needham channel viewers, and welcome back to another episode of Real Money Moves. I'm your host Connor Gillen, and on today's episode we're going to tackle one of the most common questions I'm getting from my clients right now. Should I buy a home in today's market or continue renting while interest rates remain elevated? There's a lot of noise out there on this topic, so today I wanted to break it down using real numbers, real scenarios, and give you a clear framework to help you make the best financial decision. Let's take a look at a realistic example here in Needham. Say you're considering purchasing a home around $1.2 million, which is fairly typical for this market. With a 20% down payment and an interest rate in the mid to high 6% range, your total monthly payment, including taxes and insurance, is likely going to fall somewhere between $7,500 and $8,500 per month. Now let's compare that to renting. A similar home in today's market might rent for somewhere between $3,500 and $4,500 per month. So at first glance, renting appears to be significantly more affordable on a monthly basis. And for many people, that's where the analysis stops. But in reality, that's only part of the picture. When you own a home, your monthly payment is made up of several components: principal, interest, taxes, and insurance. And one of the most important distinctions between owning and renting is that a portion of your monthly payment, specifically the principal, is actually going back to you in the form of equity. So while your overall payment may be higher than renting, not all of that money is being spent. A portion of it is being saved and contributing to your long-term net worth. This is one of the fundamental differences between renting and owning that often gets overlooked. Another major factor to consider is appreciation. If you purchase a $1.2 million home and it appreciates at an average rate of 4% per year, which is relatively conservative in a strong suburban market, that equates to approximately $48,000 in value gained in the first year alone. Over a 5-year period, that number approaches roughly $240,000 in appreciation. This is where homeownership becomes a powerful wealth building tool, as homeowners benefit from increases in property value over time, while renters do not participate in that upside. Of course, interest rates are a major part of the conversation right now. Many buyers are hesitant to enter the market due to rates hovering in the 6% range, which is understandable. However, one of the key principles I always share with clients is this: you marry the house, you date the rate. What that means is, while you may be purchasing at today's interest rate, you always have the opportunity to refinance in the future and when rates decline. On the other hand, if you choose to wait, you run the risk of home values continuing to rise, which could result in paying more for the same property down the line. Additionally, renters remain fully exposed to potential rent increases each year, without the benefit of building equity or locking in a long-term cost basis. Now let's take a step back and look at the bigger picture over the 5-year period. If you're renting at $4,000 per month, over the course of 5 years, you'll spend approximately $240,000 in rent with zero return on that money. If you purchase a home, however, the financial picture looks very different. Over that same 5-year time frame, you could build anywhere from $100,000 to $150,000 in equity through principal paydown, depending on your loan structure. At the same time, assuming modest appreciation, the property could increase in value by over $200,000. When you combine these two factors, you're looking at a potential difference in net worth of $300,000 or more over a same 5-year period. Same timeline, but two very different financial outcomes. So when you really break it down, the decision between buying and renting is not about the monthly payment. It's about how you want your money working for you over time. And while every situation is different, understanding the long-term financial impact is what allows you to make a smart, informed decision rather than an emotional one. If you're currently weighing your options and want to take a deeper look at what makes the most sense for you, I'd be happy to run a personalized breakdown based on your goals, your timeline, and your financial picture. And as always, you can reach me at the contact info on your screen. I'm always happy to help. Thank you for tuning in to this episode of Real Money Moves. I hope it provided some valuable insight as you navigate today's market. I'm Connor Gillen, and I'll see you real soon.